Welcome to the Daily Update, where I'll go over the action in the market from Monday, June 10th, and then we'll see how things look for Tuesday, June 11th. Pretty sleepy day, no economic reports coming out. We saw a bit of an upward move. We're still looking positive, but we have these areas that are negative that are kind of significant, and they're not really improving. But we'll just keep an eye on those things. We have CPI and PPI coming out this week. On Wednesday, as well as CPI, we have the FOMC, and they're probably not going to change rates. It's going to come down to what are they going to say, both in their release and in the press conference. So that's what the market is waiting for, and it didn't have all that much to really key off of in Monday's session, but it ended up being a positive day. We were up slightly, but we're not trending right now. Before I get going into the video, the announcement that I have been making is that the SPXInvesting Program has now launched. If you want to talk to me about this, here's an email. There's also links in the description below the video that take you to some videos that you can watch about the program just to see if you're interested in that. And also a link that takes you to the website for the SPXInvesting Program to give it a try. For the month of June, it is free. So feel free to check that out. It'll just cost you an email address. If you end up not liking it, just unsubscribe, and that's all she wrote there. As far as talking about what happened, we'll go through and discuss this, and then I'll go through some charts. Right at the open, we had a lower open, and prices were able to rise up to the unchanged level and to the daily pivot at 53.51. That 53.50 level is kind of significant now. It seems to be the area where the market goes above that, we look more positive. If we drop below it, we look more negative. But that's very short term, and that can change at any time. As the day went on, we chopped along the daily pivot before closing slightly above the daily pivot. So we were up 0.26%, and this is interesting. We were actually above average with volume, one of the higher volume days that we've seen in a while. The last time we were above average with any conviction was the last trading day in May, on May 31st, which was a Friday before Memorial Day weekend. And that was the end of the week and the end of the month, so there may have been some window dressing going on. We actually saw a pickup in volume in Monday's session. We are positive with our technicals across the board, but there are things to be concerned about, and that's always the case. But these things that we're looking at could be significant, but at the same time, they could get taken care of as well. And then we have all the geopolitical events that we want to keep an eye on in case they impact the market. Some comments. We did set a new all-time high with the S&P. Not an awful lot of conviction behind that. We didn't see a real upward thrust as far as price. It was nice to see a pickup in volume. There was weakness early in the day. We did gap lower at the open, and then that was the low. And we didn't close at the high, but we did a pretty good job of recovering from that point forward. Apple came out. Of course, you've got AI, artificial intelligence. Apple has to cleverly come out with Apple Intelligence. That was released over the weekend, or it was announced, I should say. NVIDIA, the 10-for-1 stock split kicked into gear in Monday's session. On a short-term basis, we do have our stochastics, Williams percent R, CCI 14 and 20, showing that we're extreme positive with these indicators, but at the same time, that can suggest good momentum. We do have the ultimate oscillator on the intermediate term that's drifting higher there, but that's the only one right now. We're still going with the scenario. We'll see if it changes this week with the FOMC meeting and press conference, that the Fed is keeping rates higher for longer because inflation hasn't been coming down as expected. Even over the weekend, if you watch the weekly video, there's still kind of a 50-50 chance that they're going to keep rates the same versus that we may get a 25 basis point cut in the September meeting. But that's going to change a whole lot. If you remember back to the beginning of 2024, they were looking at March, and then I got bumped out to, the next meeting and the next meeting and the next meeting. And so there's a lot of people that think that we're not going to have a rate cut at all in 2024. Of course, nobody knows that for sure. We'll just have to see how things work out. There's been this idea that economic growth may be a little bit too slow, and that's causing a bit of concern for the market. So we're trying to see that balance between, is good news going to be good news? Is good news going to be bad news? And vice versa as the market works through this particular time. The dollar was up and interest rates were up, and that may have limited the upside potential for stocks on Monday, because the 10-year yield closed at 4.47% after we had closed at 4.43% on Friday, and the dollar bouncing up. That these together usually put pressure on stocks. We're still inverted with the yield curves. Sentiment is still neutral at 48, where we had been at 45 after Friday. We're still not trending. Now, in the short term, the ADX is trying to turn back up above its moving average, but it hasn't crossed yet, and we still have a ways to go with the intermediate term chart. We are positive because the green line's on top, but we're not trending right now. And I'm keeping our bias at mixed, even with the up day. It's like, there wasn't an awful lot of conviction there. But I'm keeping our momentum for positive right now, the last number of days taken together. We didn't have any economic reports on Monday, so there's no charts to show you here. Here's some Isabel Net blog charts. This is what Goldman Sachs is thinking is going to happen with Brent crude, just basic oil prices, where they think it's going to come down into the 82 range. I mean, we're in the 70s now, so it's like, okay, well, it's kind of hard to get that one wrong. But they're looking out into the future based on where we're at right now, where the futures themselves are actually predicting that oil prices are going to go down. The takeaway from this is they're both expecting a decline. It's just they're coming in at different prices. The euro has been having some issues compared to the dollar lately. Now, when the dollar was going down, that helped stocks. But lately, over the last couple of sessions, we've seen a bounce up in the dollar, and that's bringing some pressure on the euro. And Goldman Sachs is also thinking that we're going to come down with the dollar, settle there throughout the month of June, and then eventually shoot back up from that price. And then looking at the risk appetite, where folks they're not as risky as they were. They're still above zero, so they're willing to assume some risk, but they're not taking on any more risk at this time. And then what do they think is going to happen over the next 30 days? A lot of folks are expecting a pullback. GDP, usually I go over this on the weekend, but the chart wasn't available until after Monday's session. We're focusing now on the second quarter. This is still what's being projected. The takeaway from this is that we're looking at the consensus as well as Goldman Sachs, seeing that there's positive GDP going forward. Then utilities, seeing a lot of money going in. Folks are starting to chase this now. It's become kind of cool these days to invest in utilities. Of course, about the time a lot of money starts coming in is when we start to see profit taking with utilities. And then the inventory to sales ratio does suggest, and I have to move this bar here that's in the way that you can't see. It says manufacturing PMI, it's going to stay below 50. That means contraction in the upcoming months. And what they do is they shift this forward, and we're seeing the light blue line actually dropping down, and they'll think that'll bleed over into the manufacturing PMI, and that'll end up staying below 50 as well, which shows economic contraction. And this is part of the concerns over economic growth that we've been seeing. I did see one chart on Twitter. Now, on Wednesday, we're going to get CPI. And of course, JP Morgan, they have, okay, what are we going to do if this happens? And I'm not going to read through all of this. You can pause this and look at that and just see what they think is going to happen. And I don't ever come back and check these to see how close they really are to reality. I've checked these types of things in the past, and it's like, why waste your time? But people love this stuff. They like this prediction type of thing. And so they put this out there and just make it available. Here's our intraday chart. We gapped lower, not much of a gap. We never even made it down to S1, but we were able to find a base here. We came back above the unchanged level and the daily pivot. We just kind of danced along there. Tried to break out at one point, but then came right back down and then ended up closing above the daily pivot. So we never made it up to R1 on the upside. We never hit S1 on the downside. Here's our intraday chart of the SPY. Not an awful lot of changes going on. We did open Sunday afternoon or evening with the futures. and they were a little bit lower. And then I was watching this. We saw the futures really improve and then pull back as we got into the cash session, but then we were able to bounce up and show some more strength when the stocks finally opened in New York. We're still looking okay with the intraday charts when we compare growth to value. That's strong with the blue line above the red line. And we're seeing it look okay here with the growth to value ratio intraday for the S&P. And we were up with growth. Value was also up, but up less. Growth for the mid caps was up more, and it was down, but down less for the small caps. So a little bit of an improvement here with the small cap growth to value ratio, a little bit with the mid cap growth to value ratio, a little bit with the S&P growth to value ratio, but not a real leadership role at this time. This is still looking okay. The ETF growth to values that we look at here were above the rainbow, and it's going back up, but we didn't see a change in Monday's session with this. And this is looking a little better when we look at discretionary versus staples. But again, it's not because discretionary is doing all that great. It's chopping sideways. We're seeing some weakness in staples, and that's what's causing this ratio to go up. Large cap growth doing okay, coming in at an all-time high. The Wilshire not setting an all-time high, but still hanging in there and looking positive. This, I haven't shown it in a while, but we're finally seeing a bit of a breakout when we compare large caps to small caps. Small caps are under pressure. Large caps had a pretty good day. Small caps were down, and so we're seeing this ratio going up here. Looking at our trend, we're still below the moving average. We're still below 20. That means we're not trending, and it's a weakening trend. But the green line is on top, even though it is declining. So we would default to positive as far as our bias, but we're not trending right now. Short term, we're trying to turn up above the moving average, but we haven't quite done that yet. The green line is also on top, but declining. We did see a pickup in volume, not enough to really change this oscillator over to positive, and we don't know if that was just some kind of a one-day wonder there. Looking at sentiment, this is a composite where we take a lot of things together. We're coming in at 79.16, which is still in the extreme greed, or I would say extreme positive territory. Another thing that we usually look at once a week are what are insiders, legal insiders, doing as far as buying and selling shares of their own company. We're back to neutral right now. And when I look at this chart, I also bring up the insider buying ETF. This is a big deal. This is a real strategy for a lot of people. My problem with this is there's a lag of what's going on, but there's websites out there that can keep you more up to date. They say, oh, this person bought or sold shares within this company, and then people buy or sell based on what they see in those reports. And that's one strategy that people can use. We're coming right back up to the 50-day moving average with this ETF. The Ulcer Index going sideways right now and still under the moving average as far as not showing a lot of fear. We don't have a latest reading here with Investors Intelligence. We ticked up with the closing value of the VIX, and we came up a little bit with the bar chart, but we closed well off of the highs for the VIX. We're seeing the VIX of the VIX picking up a little bit, showing that the volatility of the VIX is starting to go up, but it's still below the moving averages as well. When we look at the VIX, we're coming down. We did go up in Monday's session, but the momentum as measured by the MACD is still starting to roll over, but it has not crossed below its moving average. We're continuing to decline with the daily chart with the equity put call ratio. We're continuing to decline with the 5-day chart. This is more positive for the market. We're still above this band right here when we look at volatility risk premium, but it has been coming down. We were up with this fear gauge. We were down with this other fear gauge. So we're seeing a bit of a contradiction there. Our advanced decline line studies, we're a little bit concerned about this because we're setting an all-time high with the S&P. At least, you know, we're chopping sideways right now as we're not trending. But price is not confirming that. We haven't gone above this previous time that we set an all-time high. So that's a negative divergence. We're holding up a bit better when we look at volume, and that is the positive takeaway. And we're seeing that in a number of our different charts that I'll point out as I go through this. We saw a contraction of new highs, but we're not seeing any kind of an expansion in new lows. So on the 5 period, it's right on top of its moving average. We're still declining with the 10 period. And we're still seeing a mixed signal here, where the blue line, which is shorter term, is below zero. The red line, which is more intermediate term, is above zero. This is positive. Accumulation distribution is above an advancing moving average and getting stronger. This is a smart money indicator. We're also seeing some improvement here with the chicken money flow. We were actually able to get back above the moving average, and the moving average is starting to turn back up. The chicken oscillator is turning back up. Now we got above this red line and then fell back. We'll have to see if we can continue to go up higher from here. And this is what I'm talking about with when we're looking at different things. See what we talk about with price here, where the cumulative advanced decline line, yeah, it declined. The regular advanced decline line, okay, it declined. And this other advanced decline line also declined. But when we start bringing volume into the mix, you can see the common stock on the NYSE, we went down with price, but we're going down a lot less based on volume. Also with S&P, cumulative, based on price, saw a little bit of a tick down here, much less of a tick down when we look at this based on volume. We are a little bit concerned here. We're coming back down to the moving averages with the NYSE common stock. We're just a little bit above for the S&P. We're dropping below with the mid caps and the small caps. So we're not seeing across the board strength here. Here's our daily chart. Really not much that we're hitting on this chart. We do have some pivot points above current price. We have the 50-day moving average and this trend line here and other pivot points if we start to fall. Down on the bottom, you see where we did spike up to the above average, at least for Monday's session. We're extreme positive with the Williams percent R, the CCI 14, and the CCI 20. And we're extreme with the stochastics in the short, intermediate, and long term. Now, we're right about on the green and blue lines here with our 20-period moving average study. We want to stay above this. We want to see the lines continue to go up for the short term to be more positive. We ticked up just a little bit with the 20. We're actually declining with the 50, turned up a little bit with the 200 here. And we're positive with the force index still. We're still above the regular 20-period moving averages that we follow. And both lines are going up, and the red line's above the blue line. So that's still looking okay. And we're still in the +2 standard deviations channel here. So we're looking positive, but not extreme. Balance of power coming up just a little bit above zero, so it's turning slightly positive. The go, no go is still positive. We're still looking positive with the highest high value. The TTM squeeze is still trailing off, and we turn to a darker shade of blue here. It's positive, but it's continuing to decline. And then our 50-period double and triple exponential moving average study, still above both of the lines here, and we were able to recapture that. That's positive. Can these lines continue to go up? It will be even more positive if the red line crosses above the blue line. And here's our 50-period moving average study, still looking pretty strong there. Ease of movement declined a little bit, but it's still positive. The Erin also declined a little bit, but is positive. This is where we're seeing some warning signs. The S&P McClellan oscillator continues to be negative. It ticked up, but it's still below zero. So when we translate that over to the summation index, excuse me, we continue to decline based on price and volume. We're seeing that same thing with the NYSE McClellan oscillator. Barely a tick up, but still below zero. So with the NYSE summation index, we're declining based on price and volume. And this is a concern, both the short to intermediate, even longer term intermediate term. We want to see these indexes confirm what we're seeing with price. Swenlin trading oscillator below zero and turning negative based on price. We did decline, but we're still above zero based on volume. So we're getting some mixed signals there as volume tends to hold up a little better. We're trying to turn back and look more positive with our momentum oscillators. We're going back up with the PMO, but we're still declining based on price and volume. So we saw a bit of a tick up with the PMOs that are rising. The buy signals are showing a bit of an improvement, but we're still declining with the PMOs that are above zero. We're positive with the Elder's Impulse system with the S&P. We're positive with the parabolic SAR. The slope oscillator still below its moving average, but trying to turn up. The MACD is actually looking a little more positive. It didn't go quite as negative as the slope oscillator did, but it's coming back above its moving average. So we are seeing some improvement here. In the short term, we actually have turned back positive with the TSI. We're turning back up with the MACD, the PMO, and the PMO. So intermediate term, we're seeing some improvement with momentum. Long term, we're still right on top of the moving averages. We're above all the plotted moving averages here. That's still positive. We didn't see much of a change here with the bullish percent index. We're still above 50, so it's positive, but we want to see this go back up. But it's not doing that. We're continuing to decline with the NYSE bullish percent index, but we are above 50. This is another warning sign. The NASDAQ 100 bullish percent index is below 50, and it was flat. We want to see this break above 50 and continue to go up to be more positive. The money flow is still looking positive, and we're starting to get extreme positive with the ultimate oscillator. The vortex is showing that the green line is on top, but it is declining. And we're looking okay with the RSI, both based on 14 and 9 periods. On balance volume is positive. The stocks above their 20-period moving averages ticked up a little bit, but still below 50. This is more of the weakness in the short term that we're seeing. This just means that fewer stocks are participating in any kind of an upward move. And we're still keeping an eye on our study here, wondering if we're going to see any follow through to that initial upthrust that we saw back in May. And we're just one tick below 50 with the stocks above their 50-day moving averages. This is a little bit more of a concern for the intermediate term. And we're still declining with the 100, and we're declining and flattening out a little bit with the 200, but they're still positive longer term. The Copic curve is negative. The Sean trend meter is no longer extreme positive and has dropped down. And we're keeping an eye on this. This is the Amex, NASDAQ, and NYSE. We have been positive for most of 2024. When we take a 5-period moving average of the highs minus the lows, well, we're starting to drop a little bit negative. Now, we can come down here and it can last for a little while. What we want to see is it going to stay down here for an extended period, or is it going to be able to turn and go back up? Don't have any support or resistance levels because we really haven't been going anywhere. But on a trending basis, the Heiken Ashi is positive, the Kegi is positive, the Renko is positive, and the 3-line break is positive. Longer term, we're still below this red line with the 150 and 200 period moving average study. We have not received a confirmation yet as far as an Hindenburg omen is concerned. We're looking for another spike up here before I'll have to calculate the actual days. It's near the end of June. Looking at our indexes, we're still negative with the mid caps and small caps in the short term. Everything else is positive. We're positive now with bonds based on price in the short term, but still negative in the intermediate and long term. Commodities continue to be negative in the short term. The dollar is showing a little bit of strength lately. And they did update this here with the decision point scorecard. After Friday's session, we're positive across the board. And we saw some positive action earlier on in the day, but this was the dollar. It had a MACD crossover, which could be pressuring stocks, and the dollar going above 105. Then we saw some real negative things going on. And then right at the close, we saw where the S&P set a new all-time high. Looking at the different sectors where utilities, which had been seeing some profit taking, were up in Monday's session. Energy was one of the strongest areas. Real estate, another area that's been under a lot of pressure, and healthcare. Taken together, these are more defensive. Energy is kind of the wild card here. Sometimes it is, sometimes it isn't. Discretionary was up, but not all that much. We saw some profit taking a little bit in the financials, materials, and staples. And we also want to keep an eye on this. With the NYSE, just the raw score, the new highs minus the new lows, we're coming down and starting to drop below zero. The equal weight is really underperforming right now. That's why we're seeing this ratio really going up. That means that the bigger stocks are having most of the impact. The Dow is just kind of chopping sideways right about at its 50-day moving average and on this pivot level. And we're still positive, though, with the we've switched to positive with the Elders Impulse system for the diamonds. Not really much of a change here with the NASDAQ or the NASDAQ 100, but we remain positive with the Elders Impulse system for the Qs. The momentum is shifting back to positive for the NASDAQ 100. Now, this is a post, and it's freely available. You can go to stockcharts.com and read this. That's why I didn't have a problem copying and putting it here, because it's publicly available. This is a study that was put out over the weekend by Swenlin, and he's somebody I really respect. I've learned a lot about technical analysis. He's since retired, but then does some like guest posts, and now his daughter runs decisionpoint.com. They used to have a stronger relationship with stockcharts.com than they do now. They kind of have broken back away and are doing their own thing. But a lot of the indicators that you see that I use, they were developed by him. And he has a concern about technology right now, where it says the tech sector continues to dominate and drive the rally, but fewer and fewer stocks within the sector are actually participating in the rally. We know because our Silver Cross, which shows the present percent of stocks in the tech sector with buy signals, and that's when we see the 20-day cross above a 50-day moving average, it's only at 55.38%. Almost half of the stocks are not on buy signals. And if you want to pause this and look at it, or go to stockcharts.com, there's an article section. You can click on that, look for decision point, and you can look at some of these things. He's put a lot of annotations here. Then he goes on to say in the next chart that the data that we have, the Silver Cross here, we are unable to find another case where the tech sector was making all-time highs, but the Silver Cross index reading so low that didn't lead to price weakness. This is part of the concern that I've been alluding to here. He broke it down a little further in this post. Of course, we owe this dislocation of the magic of cap weighting. That's why we get some skewed results sometimes. While fewer and fewer tech stocks are participating in the rally, the mega cap stocks are the ones that are making new highs, driving up all of the indexes. And I deal with that all the time. The numerous negative divergences we can see are telling us that we probably won't continue for long. Now, he doesn't really come, he causes this. Okay, let me give you my takeaway from this. He's not concluding that we're going to fall apart. He's just seeing some weakness that could lead to some declines. But if we see some strength coming back into the market, in my opinion, that could get taken care of. If we don't see this taken care of, that could lead to further price weakness. And he would probably be leaning more towards the weak area. I'm waiting to see the evidence first myself. Small caps were down, coming back down to the S1 level here. And we're negative with the small caps with the Elders Impulse system. We're also looking more negative with the Russell 2000. We ticked up a little bit, but we're below 50 with the RSI. We're below the 50-day moving average. Longer term, we're still in an uptrend, but the shorter term momentum continues to be negative. The mid caps, this has been another area of disappointment. They were up slightly, but still below their 50-day moving average. And they've gone from being negative to neutral with the Elders Impulse system. Apple actually was down. They come out with this Apple Intelligence. Isn't that interesting? Why don't they call it intelligence, like the iPod, iPhone? But apparently that didn't work out. They were going to have to switch things around. The thing here is, yeah, they were down almost 2%, but we're above both of these moving averages, and we could be getting ready to see a golden cross. Tesla still dancing along its 50-day moving average, also down 2%. NVIDIA, which is everybody's darling stock these days, is still looking solid here. Microsoft was up above its 50-day moving average. Meta was up almost 2%. Amazon was up 1.5%. And Google was up 1/3%. So these bigger stocks are looking okay for right now. And then Netflix was also up just under 0.5%. The FANG index is chopping more or less sideways as we're seeing all this calculation going on with some stocks being down and other ones being up. It's not really breaking out, but it's setting recent all-time highs. The financial sector was down, still dealing with its 50-day moving average. We saw a little bit of a decline here with our staples to tech ratio, and that's what we want to see if we're going to be more positive. We want this, if you're more positive on the market, you want to see the tech sector really outperforming, and we want to see this ratio going down. If it's going up, that could be a sign of pressure on stocks. The dollar was able to get back above the 105 level here, and it's still in an uptrend. And looking at the S&P and comparing it with the world index, a little bit of an improvement here with the short-term relationship, really no change with the longer-term relationship. The staples sector was down slightly, but still above its 50-day moving average. This has still been one of the stronger areas of the market when you take it by itself. It's underperforming the S&P, as I showed over the weekend with the intermarket analysis video, but by itself, it's in an uptrend. And we saw a bounce after we've been also witnessing some profit taking with utilities, but it's still in a longer term uptrend. Healthcare, another defensive area that we're keeping an eye on, was up over 1/3%. Energy was up 0.8, 0.79% here, but still below its 50-day moving average. These are more the defensive areas we're just keeping an eye on. The total stocks still coming off of setting either at or near all-time highs. This is also a concern. We're seeing the 10-year yield going back up. Now, there's a lot of variables left in this week. We have CPI, PPI, the Fed, and this is going to dance all over the place. So at some point, if this is going back up, that's probably going to pressure stocks. If interest rates go down, that would give support to stocks. And we're also declining with the 10-year based on price. The market is still figuring that we're going to have a soft landing where we see the stocks, or the S&P is outperforming 3 to 7 year bonds. Then here's an inverse of that same thing, showing how bonds are underperforming stocks. When we look at the broad market and compare it with short-term bonds, stocks are still outperforming. Another broad market measure looking a little further out shows that stocks are outperforming. The Qs to 3 to 7 year bonds also going up now. That means the Qs are outperforming. The tech sector is outperforming 3 to 7 year bonds. But we're not seeing an awful lot of improvement across the board here with our growth to value ratios. It's okay with the Qs to S&P. It's above its moving average, and the moving average is going up. Where we're seeing some problems are discretionary to the S&P. But when we compare large cap growth to large cap value, that is improving. So the large caps are looking better. Not much of an improvement with the mid caps, and ticked up just a little bit with the small caps. This is a negative and a positive at the same time. We're below zero with the 19-day exponential moving average of the advanced decline ratio, but we're above zero when we calculate that based on volume. That's the positive side. Then our S&P to utilities ratio, it ticked down just a little bit. We want to see this going up, meaning that the S&P is outperforming. The Staples S&P ratio did decline. We want to see this continue to decline to be more positive for the S&P. So what's our outlook for Tuesday then? I really am not changing much because things aren't just really happening at this point. We are still positive for right now. There's some strength that's coming in, but it's mainly these really big companies that are holding things together. There's this weakness that we want to be aware of that I'm seeing not only with our McClellan oscillators and our summation indexes, but if you get some time, go through that article that Carl Swenlin posted. It may be well worth your time, and it's free. Now, the positive seasonality, that's starting to end right now as far as what we're looking at, but we haven't really been following it all that close anyway. We're going to get the NFIB Small Business Optimism Index, not a major thing, but still something we want to keep an eye on, and then all the different geopolitical things. And then on Wednesday, we're going to get CPI and the Fed. We're going to get PPI on Thursday, and then on Friday, we're going to get consumer sentiment. So it's a pretty hefty week as far as economic reports. And then there's going to be a 10-year note auction on Tuesday. Sometimes this is a non-event. If it's well received, it might help interest rates go down. If it's not well received, it might make interest rates go up, which can ultimately feed over into the stock market. Seasonality, we are negative now as far as June 11th across the board, and quite negative at that. Tuesday also tends to be one of the worst performing days compared to how things went in 2023. This is where we're starting to come out of some positive seasonality during an election year, and we could see, at least on a seasonal basis, some weakness going back down into about the 13th or so of June. But June tends to be pretty good during an election year based on what Carson came up with. It's up 75% of the time with a gain of 7.3%. Now, July and August are also positive, but we really taper off as far as the returns. And then Tom Bowley has us going into this negative time right now as far as his research is concerned. So the S&P has made a new all-time high with staples and utilities being strong. We're still keeping that in the back of our mind because it's still relevant, but the further we get away from that, the less relevant it will be, but it's still back there. We're not going back and setting new all-time highs. the staples and utilities are still kind of strong, and we're taking that as a warning sign for right now. We're also keeping an eye on energy and healthcare. The advanced decline lines are not really holding up, especially when you look at them based on price. They're looking better with the ones that we follow when you just isolate volume. Growth to value and discretionary to staples, they're not leading like we would normally see in this kind of an environment. The McClellan oscillators and the summation indexes for the S&P and NYSE are negative. The Swenlin trading oscillator is turning negative as well, especially based on price, but holding up a little better based on volume. The oscillators are negative, but showing some improvement and starting to try to turn over and actually become positive. The Copic curve is negative. The 20 and 50 moving averages, the stocks inside the S&P, they're still negative since they're below 50. And the bullish percent index for the NASDAQ 100 continues to be negative, even though it ticked up in Monday's session. And I think I got this wrong here again with where I'm putting this little bracket. But the equity put call ratio is going down. On the positive side, we have the parabolic SAR being positive. The bullish percent index is above 50, and it's not really moving, but it's ticked up a little bit. I guess I did get it in the right spot. Accumulation distribution, Chaikin money flow, and the Chaikin oscillator. I treat these as one unit together, and they are positive right now. The money flow, the ultimate oscillator, may be getting a little too positive. The vortex, the green line's coming down, but we are still positive there. The financial sector and the momentum for the NASDAQ 100 is showing some improvement and actually turning positive. So our conclusion, we're positive for right now. There is this strength that has been coming in. There's weakness in the background, and I probably should have taken this positive seasonality off of here because we're kind of beyond that window for the time being. We're looking okay right now in the short term, but this weaker things that are developing are causing us a bit of a concern. We're also seeing that more, and it could be a little more prevalent in the intermediate term, where in the long term, we are still positive. Thank you. I really hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.